Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to a very late but still going Chart This with Dave Keller for Wednesday, November 12th. We're coming to you from the other side of the country here, from Rochester, New York. There's actually still a little bit of snow on the ground, but it is otherwise kind of Seattle-like weather with some drizzle, just to give you the full weather report. Out on the East Coast here for the rest of the week and into Monday. Taking my daughter on a college tour. So that's a whole life thing that my wife and I and our family are struggling with. With that in mind, though, sorry for the late show today, but I did fly from Seattle out here to Rochester, so I had to get to this when I could. Quick update on the markets. What we'll do today is just talk about the market conditions. Choppy session for stocks. We'll see the S&P 500 basically narrowed the range through the course of the day today. We're going to talk about how we continue to see growth underperforming value at the Nasdaq under the Dow. We'll talk about the resurgence in gold and silver, particularly the gold miners, and a couple charts I've hand selected to focus in with you in this abbreviated but hopefully still quite helpful Chart This episode. Thanks so much, by the way, for tuning in. Please drop questions in the comments section on our YouTube channel. We're planning an all-mailbag episode on Friday. We'd love to answer one of your questions on the air. All right, S&P 500 essentially unchanged from yesterday, from Tuesday's session, closing just above 6850. This is where we closed yesterday. This is where we closed today. So you can see we opened higher. We traded lower by lunchtime and then just sort of centered into that range. I haven't put Fibonacci retracements on this high and this low, but I'm super tempted to do that just to show you how this probably settles in pretty well with kind of a Fibonacci relationship. All right, I have to do it. It's my show, so I'm doing it. All right, here we go. Let's see, S&P, and we'll look at an intraday chart here. And we'll zoom in to just the last one day. And what we will do is let's see, annotate. We'll go to Fibonacci retracements. We'll take this high soon after the open. We'll take that low, and I'll kind of extend it in there. Yeah, so how did this go? I mean, not perfect, right? I mean, if you look though, right? So if you take that high in 930, 940, you take the low. The eventual low for the day was here around 1145. 38.2% of the way back up is around 68.45. That's pretty much retesting that little swing high. Then we break up. We kind of stall out here. We ended up trading up a little bit above the 61.8% level, but not by much. We then traded down to the 38.2%, traded up to the 61.8%. Look at the big shooting star candle going into the close. Not perfect, and I don't look tick by tick on the 5-minute chart of the S&P 500, but the moment I saw that, certainly looked like Fibonacci levels could have been a helpful way to just sort of track things through the course of the day. Sort of a narrowing of the range, lower high, higher low through the close. So what does this day really mean with limited change in the S&P, with basically a narrowing of the range through the course of the day? It's an indecision day. After yesterday with a nice rally through the course of the afternoon, today more of a sideways equilibrium day, right? Here's where we closed yesterday. We really were sideways in the last couple hours of Tuesday's session. Today, we basically had a noisy rotation right around that same level. So still an open question as to what might come next. I'll tell you what's not feeling like much of an open question is the strength of value over growth, particularly this week. We can see the Dow up 0.7%, Nasdaq down 0.25%, mid caps and small caps. We have small caps slightly lower, mid caps up about 0.33%. Volatility up a ton, not horrible though. But did go up to around 1750. Again, anything below 20 is still a low volatility environment by my definition, but that's certainly something we would be keeping an eye on. Tuesday, the bond markets were closed for Veterans Day. Wednesday back open. We can see that bonds rallied through the course of the day. The TLT was up about 0.2%. Rates generally moving lower. We can see the 10-year point, which is here, getting closer to 4%. 5-year point below 3.7%, long bond below 4.7%. Dollar, no real change here. So, bond markets closed on Tuesday. They reopened on Wednesday, and basically bond prices down, bond prices up, interest rates lower. Looking at the chart of the commodity space, we can see gold up 1.6%, silver up 4%. We talked last week about that pullback in gold, and really in the last couple of weeks, we've seen a significant pullback after gold spiked up to $4,300 an ounce or so. Pulls back down, but now starting to bounce higher. This week, we're seeing a resurgence in that precious metals trade, pushing to the upside. So in the commodity space, I would say that's one of the stories. The other story is severe weakness in crude oil prices. You're going to see that energy was the worst sector out of the 11 today. You'll see that particularly on the heat map. Looking at cryptocurrencies, not great. Bitcoin did get up to around 105,000 yesterday, but currently trading down around 101,700. Ether prices just above 34.20. Basically, coming off of where they were over the last 24 hours, trading to the lower end. That 100,000 level, big round number, super important for Bitcoin, one we are certainly following pretty closely. Looking at the 11 S&P sectors, healthcare, financials, materials are your top three. Healthcare has been toward the top of the list here a lot recently, I feel like. And when I'm scanning for stocks making new swing highs, I'm finding healthcare, I'm finding financials, and that's number two. I'm not surprised, up 0.9%. Materials third, gold stocks obviously in that sector, along with steel and a bunch of other names, up 0.7%. On the downside, energy down 1.4%, real estate down 0.8%, consumer discretionary down 0.7%. So defense over offense, still the story here with the XLP outperforming the XLY. That means that offense to defense ratio rotating away from offense through the course of this week, back toward the defensive side. We've talked a lot about weaker breadth conditions. I interviewed Andrew Thrasher for my podcast yesterday. Still waiting to get that ready for you with the editing process, but hopefully we'll get it out to you tomorrow morning. But Andrew had some really awesome thoughts about breadth conditions, and we are very kindred spirits in terms of a focus on breadth and respect for breadth conditions as being a great way of recognizing, sort of underneath the hood, evaluations of the health of the market, right? And breadth has not been particularly good. However, in the last week, right, in the month of November, we've seen a decent improvement, particularly in the last couple sessions, of breadth starting to turn higher. And we're seeing that here with 59% of the S&P 500 members going up today, only 40% going down. On the New York Composite Index, though, pretty even, 49% up, 48% down. On the Nasdaq Composite, more down than up. On the small cap ETF, or small cap index, that is, more down than up. So really, split. Look, mid caps 50%, 57% higher, small caps 55% down. And then the New York Composite Index, which is the broadest universe represented here, almost a coin flip. So not the great strong breadth conditions we've been observing here so far. A bit of a change there. Looking at the Magnificent Seven and Friends sort of leading growth names, Netflix up 1.9% to be the best performer out of this bucket. Broadcom bouncing higher. We talked about Broadcom testing the 50-day moving average. We've had a number of pullbacks to the 50-day for Broadcom. Every one of those since May has been a pretty decent buyable opportunity. For now, we're seeing another bounce off of that 50-day moving average. Microsoft coming in about 0.5%, NVIDIA up about 1/3%, which is good to see because that's obviously one of those leading names under pressure. Speaking of former leadership names not doing well, Meta is it. I think the worst chart in this bucket, not even close, would be Meta down another 2.9%. They're very much coming in behind the rest of these leading growth names in terms of performance. Also note Tesla and Amazon both down about 2% today. All right, we'll look at the heat map. As a reminder, I appreciate you putting questions in our comment section of our YouTube channel. We'd love to hear from you. We look at every question that comes in through our YouTube comments, and I'll try my best to respond to every one of them, but we'll hand select some of those questions to share on the show on Friday and spend a little more time digging into some of those great questions. All right, continuing this abbreviated episode, I'm immediately drawn to the strength in healthcare. Charts like UNH, Eli Lilly, ABBV, all having pretty strong days here. Eli Lilly, very much a positive outlier, up another 3%, closing above $1,000 a share Talk about a big round number that's eclipsed. It's being eclipsed there. We'll look at Insulet, ticker PODD. Nice sort of breakout here. Test the 200-day. Look at how many times this stock has tested the 200-day over the last year and a half. Every one of those times, we've had a nice upside bounce. Breaking above the 50-day after testing the 200-day has been sort of the signal you're looking for, and that's happened this week, right? Tuesday session, we closed above the 200 or the 50-day. Today, following through, moving to the upside. It reminds me of a couple other charts I'm going to show you here in a moment, but for now, I would say PODD. Nice short-term breakout there, and the RSI just pushing above 60, which is usually pretty encouraging. Other things that look good, the financial sector. I had a lighthearted exchange over X with my friend Ryan Dietrich, fellow Buckeye and a fantastic technical analyst and market strategist. He was highlighting how European banks look so strong. That's 100% right. I mean, the question was, how bearish do you want to be when European banks look this good? And that is a valid, 100% valid perspective. Very, very fair. I mean, I look a lot more at U.S. banks, and I'm seeing Morgan Stanley making a new high today, Goldman Sachs making a new high today, Wells Fargo made a new high last week, Citigroup very close to eclipsing its September high. So there's sort of these big money center banks, J.P. Morgan, all breaking out, and a lot of European banks like DB is a good one, Deutsche Bank, breaking out. And so the idea there is, how bearish do you want to be if the financial system as represented by these big, conglomerate banks are looking so good? And that is a very strong point of view. And I wouldn't be surprised if the benchmarks do not look as good as the financial sector, because the benchmarks are not dominated by this one. They're dominated by this one. Technology is a way bigger weight in the S&P. So if Goldman Sachs, Morgan Stanley, and Bank of America are all just trending higher, and NVIDIA, Apple, Microsoft, and Broadcom are all trending lower, the S&P and the Nasdaq are going to be down, and banks are going to look fantastic on a relative basis. They'll look great on an absolute basis, and that's why I always say it's always a good time to own good charts. If those charts are good, they deserve a second look. But the benchmarks are driven by these big mega cap growth names, and that's where I'm seeing vulnerability. Amazon and Tesla both down today. Alphabet and Meta both down today. So we're still not seeing enough of those big names just resuming their uptrend phases. There are stocks in this bucket that are looking quite good. For example, Apple, which made a new all-time high yesterday. But a lot of things are not doing that, and I think that's where you want to be focusing your attention for sure. Also note some of the weakness in energy here. Crude oil prices, as we mentioned, right? The energy sector is a compelling, allocation in my opinion, right? The way that you think about, do I want to make an energy bet? It's got to be based on an expectation for rising crude oil prices, because that is what's going to cause these stocks to do quite well. It is a play on crude oil. So if I think crude oil is going to go higher, that's a great way to get exposure to that theme. The problem is crude oil has generally not been going higher. It's been generally trending lower over the longer term time frame. And today just took a big step downwards. And as a result, leading names that have looked pretty good in this sector are struggling. For example, SLB, which made a new 3-month high earlier in the month of November, pulling back quite a bit. All right, shall we finish off looking at some charts here, and then we'll finish this abbreviated session again. Thanks for being patient today. Apologies, the schedules. I find living in Seattle and going to the East Coast, the timing of those flights is never great. I mean, you lose a day or you lose your night, and I'm a big fan of getting a night's sleep, which means I'm traveling during the day, which means the kickoff times when I can land somewhere and get a laptop fired up are later than I want sometimes. So thanks for hanging in there. If you're watching the show, I appreciate it very, very much. Here's the daily chart of the S&P 500. This trend channel that we drew, I don't even remember when we first put this on here, but this has been pretty brilliant, I think, in terms of just representing the pace of this trend. Remember, when you have a trend line on a log scale chart, that means this trend channel represents a consistent percentage gain over a period of time. That's what log scale is. That's what the semi-log scale is designed to do, is 1% is an equal amount on this y-axis. That's why we use log scale charts, because trend lines have meaning. It means there's a consistent percentage gain as every week, as every month progresses. And what it allows you to see is that there are these kind of short-term upswings and downswings, these peaks and valleys that form this consistent trend. And by drawing this trend channel, kind of get an idea of the pace of this trend. And at some point, we're going to break out of this trend, either above the upper channel, which would tell me the market is getting way too frothy and getting way too far over its skis, or we break below the lower boundary, which would tell me this is an issue because the trend is changing and the pace is slowing. For now, though, we are right at the midpoint of that trend channel. Uptrend is in good shape. I mentioned breadth conditions. I'm not going to look at breadth too much here. Maybe tomorrow on the show we'll dig into a little bit more breadth conditions, but note that over 50% of stocks in the S&P 500 are above their 50-day moving average. That's encouraging. The McClellan oscillator is back above zero. That is encouraging as well. If those breadth conditions continue above those crucial kind of levels, I would list that as very bullish evidence of a tactical rally here. Speaking of tactical rallies, gold is it. We saw the GDX, which is a gold miners ETF, sort of gap higher on Monday, continuing higher Tuesday, and then today a nice big update with the GDX going up another 3.3%. Newmont Mining's the only S&P 500 member that is in the gold mining space. But it's worth noting that a lot of other names that are outside the S&P but are still, large kind of mid-cap gold miners, many of them looking quite good here. This is after breaking below the 50-day moving average in October into early November, now recovering. Look how the RSI got right down to 40 and then bounced higher, which I think is a really good sign of further upside potential for gold. I'm getting ready to send out my weekly Market Misbehavior newsletter, which I usually put out randomly in the middle of the week. You can sign up at my website, marketmisbehavior.com, if you want to check that out, by the way, and get on my distribution list. But I usually just do an email once a week just to highlight some of the content I put out, but then to really just make you think a little bit, just sort of observations about investing, the markets, usually share a quote and some thoughts about it, reflect on an area of investing in things. Today we're going to talk about big picture and small picture and the importance of routines. And the example I'm going to show, and I'll just give you a quick preview of what you're going to see in the newsletter if you do subscribe to that free newsletter. Basically, the retail ETF, the XRT, is in a downtrend, and someone had mentioned, one of the viewers had mentioned on my YouTube in the comments section, I think yesterday or the day before, retail looks so bad, and then it was some other question, and I took exception to that comment because quote unquote retail is doing bad. Now that's fair if you're looking at the chart of the XRT, right? The XRT, which is the S&P Spider Retail ETF, was looking very good in May, June, July, August into mid-September, making higher highs and higher lows above all the moving averages. They're all sloping up. Now that's changing, right? We're making lower highs and lower lows. The momentum is degrading with the RSI going below 50 and staying there for most of October and November. It's underperforming. But what you have to remember is this XRT does not mean all the stocks in retail look like this. This is an ETF that holds a bunch of retail stocks. And that basket of stocks, using the weighting that they're using and their methodology, this is what the retail ETF is doing. But that doesn't mean that there aren't really good charts in the retail space. So, for example, TJX, which is an apparel retailer, made a new all-time high today and is breaking out, right? Looks very different. Here's the XRT, lower highs, lower lows. Here's TJ Maxx, which I will still call TJ Maxx, making higher highs and higher lows. Moving averages still in the proper order. RSI very high. Look at the RSI here, below 50. Look at the RSI here, not getting below 40, pushing above 60 this week. So don't write off an entire group, right? If the chart of the SMH looks bad, don't write off all semiconductors. Just recognize that the ETF's underperforming, but that doesn't mean that there can't still be good charts in that space. And I think that's where people get into trouble, is they see this and then they say, all right, retail's off, where else should I look? And that's where I think you run into trouble if you have too much of a pure top-down approach, where you look at what the market is doing and then you think about sectors and groups, but then you don't realize that it is not a stock market, it's a market of stocks, right? Just because a group does not do well doesn't mean there can't be a TJX breaking out, even if the sector ETF or the group ETF does not look particularly good. One more chart I wanted to highlight. Actually, I think two more. CME Group making a new 3-month high. I ran a scan for new 3-month highs to share with my premium members today. And this is one of the names that came up on the list. Nice breakout above 275. I like the fact that this was a sideways trend resolving to the upside. We bounced off of the 200-day moving average a couple times, rotating higher. Look at the RSI between 40 and 60, just a clear sideways trend. And then something's different, right? The RSI breaks above 60 as we break above resistance. Super encouraging, and I would say that's a great actionable signal for CME Group, implying further upside. The reason why I'm highlighting that is because it looks a lot like Robinhood right about now. Now a little different, right? CME was testing its 200-day. We can see Robinhood's up here testing its 50-day, but similar kind of big run higher, and then this consolidation. So remember, this is the type of chart where I'm kind of happy being patient, right? We're between clear resistance and support. The RSI is between 40 and 60. The signal here that I would get really excited about would be a break above this previous resistance with the RSI pushing above 60. That's what we see here, which is what tells me, okay, something's different, right? Buyers are willing to pay a little more than they were over the last 6 to 8 weeks. That's why I would be patiently waiting for that sort of signal on the chart of Robinhood. Until then, it's just not a great chart yet. All right, folks, that'll do it for today. Thanks so much for checking out the show today. Thanks for being flexible. I know this is a different format, very different time, but I did want to just share some observations about the market. I appreciate you guys tuning in so much. And remember, it's always a good time to own good charts. Have a good night, folks.